Public.com presents Leading Indicator, an investing show bringing you insights from the sharpest leaders in business, finance, and technology. With us today to talk about monetary policy's impact on disruptive tech stocks, a potential AI correction, the rally in Bitcoin, and more is Cathie Wood, founder and CEO at ARK Invest. Cathie, as always, thank you so much for joining us here at Public.
Thank you for inviting me, Anne. I'm delighted to be here.
So, Cathie, let's start off talking about your recent publication. I have it printed out here, and it's The Journey Back. And you talk about how the Fed is influencing your investment outlook. Talk to us a little bit about where monetary policy is today. You've been a very vocal critic of the Fed and the rate path we've had so far. But as you look forwards, what do you think a path to rate cuts might look like at this point?
Yes, I have been a critic. 24-fold increase in interest rates in little more than a year. That has never happened before. Many people think the early 80s were, that's where we had the toughest Fed monetary policy, but interest rates went up twofold, not 24-fold. They did go up from 10 to 20%. But that was twofold. This 24-fold was a shock to the system and complicated actually the supply chain bottlenecks, that we were facing at the same time. We believe that the inflation we saw during COVID and after COVID was the result of a massive supply shock. And monetary policy was a buffer at the time, but we don't think it was the cause of the supply shock. It was demand soaring relative to supply in the middle and after the pandemic. Now what we're seeing is the other side of that. CPI peaked at 9% in June, more than a year ago, and is down to 3%. And we think companies are losing pricing power by the month. Last week, Costco reported, and it talked about taking price cuts. Overall prices were flat at Costco. Walmart is talking about deflation. The only way to move cars now is to cut their prices. So corporations are losing pricing power. Their margins are getting hurt. And so we think the unemployment rate is going to go up. It went up to 3.9% in the last report. And we think it's going higher in this election year. And so we think the Fed, once it sees prices slice through that 2% and keep going down, meaning the inflation rate keep going down, maybe into negative territory, the Fed will cut interest rates.
And when that time comes, Cathie, when the Fed starts to cut rates, what do you think happens to the tech stocks we have seen on an absolute rip-roaring tear so far this 2024?
So last year, the market began to get a sense that the Fed was getting close to the end of raising rates, and it stopped in July 23rd. So we had a nice rally at the beginning of the year, a little setback during the summer, and then at the end of the year, as interest rates peaked and started coming down, meaning the bond market began to see the Fed having to cut rates. Then we had another big swoosh. So the market has been discounting lower interest rates, but we don't think that it has been discounting the amount of interest rate cutting that we will see ahead. So we believe that the companies that were, or the stocks that were hurt the most by rising interest rates, ours would be in that category, of course. Any long duration asset, even long-term bonds, were killed as the Fed was pushing rates up so dramatically. The other side of that is that the long duration assets are kinds of stocks in the innovation space. Long-term bonds should be prime beneficiaries of interest rates coming down.
And when you say, Cathie, that the market, it seems to have gotten a little bit more judicious in how it's looking at the rate outlook, One area there's a real question out on the market right now is whether it's being judicious when it comes to the promise of AI. Where do you think we are right now in the valuation cycle for companies that touch either right now or are promising to in the future what AI is able to deliver?
It's interesting. We think every company has the opportunity to capitalize on artificial intelligence. It is probably going to produce the most dramatic productivity gains in history. And anyone who's used ChatGPT to help write emails or papers or so forth has a sense of what we mean now. We've been talking about AI for the last 10 years. We invested in Nvidia when it was $5. So we've been expecting this promise to be realized. Now that we have something like ChatGPT, more and more people understand it, which is fantastic because companies know that if they do not harness AI, they're going to lose out competitively. So we're seeing, you might say, an arms race with Nvidia. That's the hardware side of it. There will be a software side of it. Palantir is a good example on the software side. So is UiPath. But if you think about it, any company with proprietary data that takes AI seriously and has deep domain expertise on whatever the business is should be able to use AI and drive productivity gains up dramatically. And what's interesting about that is with productivity comes wealth creation. And so we think productivity will increase for knowledge workers by fourfold, maybe more than fourfold by the end of this decade. Can you imagine doing 4 times more than you are doing right now by the end of the decade in a day's work, or maybe even saving time doing it? So the changes are going to be pretty profound. Many people say, oh, are we in a bubble like in the late 90s? I was there, and we are not. We are not. Why? Because the technologies are ready and the costs are low enough. AI training costs are dropping 75% per year. And so the AI opportunity is going to be delivered across sectors, across industries, across sub-industries as costs come down.
Cathie, you were early, I think, getting to Nvidia, clearly ahead of the cycle we're in now. As you referenced, ARK started buying into Nvidia in 2014 with a cost basis of about $5 a share. You have been trimming the position. Why is that?
Yes, we've been trimming the position because whenever I hear the word shortage, and the word shortage in the GPU space started appearing about this time last year. So there's been a year of shortages, and we believe there's been double ordering, triple ordering, and that usually leads to inventory problems. They might be short-term in nature, but if we're right and the unemployment rate goes up and companies are concerned about their margins, they're probably going to pull back on some of the excesses associated with GPUs, and they'll focus more on cost cutting within their organization. So it's just a trade-off around a cycle, but we do not believe that this bubble is going to bubble. So some people are calling that is going to end in a crash like the late 90s, early 2000s at all. This AI movement is powerful. It's real. It's unstoppable. And we are very excited about it.
There's a difference, Cathie, between the macro enthusiasm for AI and, as you've described it, its ability to touch every industry, particularly those that are data rich. But your newsletter, which I waved at the beginning, does point to a cautionary tale. I'm just going to read a piece of it. You say, Cisco Systems, ticker CSCO, offers a good history lesson. I remember well the stock's behavior at a similar technology moment in time. And you talk about Cisco stock going up 31-fold, split adjusted, quote, as its routers, switches, and other equipment dominated the build out of the internet backbone globally. The capital markets began to fund competitors even those with systems inferior to Cisco's. Let's talk about Nvidia with that history lesson in mind, Cathie. What do you think is going to happen in the chip, in the semiconductor competitive landscape? You've got Sam Altman, going to raise, trillions of dollars aspirationally, or maybe. Is this beginning to happen? Are we seeing a Cisco story starting to emerge?
Yes, somewhat. I think that AMD is certainly coming along. It's still well behind Nvidia. But what I don't think many people realize is all of the hyperscalers, so Meta platforms, Amazon, Google, Microsoft, they're all developing their own chips. And interestingly, large companies with big opportunities like Tesla has developed its own AI chip, taking a leaf from Apple's book. You may not remember this, but I remember when Nokia, Motorola, and Ericsson and BlackBerry controlled the cell phone market. Apple came along and designed its own chip for a smartphone. It was the only company to do that, and it redefined that market, a computer in the pocket. We think Tesla is the largest AI project in the world, and that it is going to redefine transportation from human-driven to autonomous. And that's what its AI chip is all about. So there are a lot of competitors. Some of them are very special purpose, like Tesla. Others, less so, like the other ones I mentioned. So yes, there is going to be competition, and that will be a good thing. One of the things that Nvidia had going for it, and it executed brilliantly, is it developed essentially frameworks. It accommodated all of the software frameworks out there. Well, AI itself now can help translate from one software code to another very easily. So that competitive advantage is starting to diminish as well.
Your position on Tesla has been a little contrarian, Cathie. At least this year, shares have been down nearly 30%. And for all the reasons you've laid out, you've demonstrated your confidence in Tesla by continuing to buy into the company. But is there anything you'd like to see Elon Musk doing differently? One of the criticisms levied at him is he's got too much going on. He's too distracted by his multiple CEO hats. And specifically, that Twitter, now X, has absorbed a lot of his time. What's your perspective on whether that multitasking has had a negative impact on Tesla, or could do at this important inflection point as AI and EV continue to collide?
Well, AI is the biggest catalyst for all innovation, and he is using AI in all of his companies. I think Elon embodies the kind of CEO that is going to capitalize on the convergences that are taking place among technologies. If you look just at Tesla, he's capitalizing on 3 of the 5 major innovation platforms that are evolving now: robotics, autonomous vehicles or robots; energy storage, they will be electric; AI, they'll be powered by AI. Those are 3 separate S curves evolving. And what he's going to do is, have one feed the other, and we think create tremendous growth opportunities, what we're calling super exponential growth opportunities. So I think Elon Musk, probably more than any other CEO in the world, understands the convergences between and among technologies that are going to take place, with AI at the center. Even X is an AI project as well. In fact, he just announced today that he's going to release an open source version of Grok, which is the AI model based on X's data. So he's got XI in the right place in terms of framing the opportunities out there, and he's just applying it to different companies. At the heart of it is AI.
One of the areas that AI is factoring into some of Elon Musk's more innovative projects, Cathie, is in robotics. And there's been a lot about Optimus in the latest version. That's a humanoid robot that Elon's team has been working on. We've seen Figure AI come out, another company in the humanoid robotic space, a young company. It's only about 2 years old, valued at $2.6 billion with investments recently by Bezos, Nvidia, and Amazon. Do you look at that kind of valuation for a 2-year-old company where there are people like Elon Musk already trying to innovate, with Optimus in this case? Do you look at that and say, okay, the public markets, you have your perspective on how they're valued. Do you think the private markets are feeling frothy or bubbly now?
No, not at all. Actually, it's the rare exception that we're seeing. What we're seeing now is the private markets lagging the public markets. Last year was a great year for innovation, but the private markets continued to have down rounds all along the way. We have a public-private crossover fund, a venture fund. And so what we've been doing is averaging down into great companies like Epic and Discord, buying into these sorts of names that have lagged the public markets recently. And we believe the public markets are now leading the private market. So in the case of Figure AI, and believe it or not, I'm going to visit them today, Brad Adcock, whom we know from Archer Aviation. I've known him for a long time. He's an amazing CEO. We're going to go and tour the factory and just see exactly where he is, and we'll get a lot more information about how quickly this market is evolving. We think that the robotics market is probably the most underappreciated from a learning curve point of view. By our analysis, for every cumulative doubling in the number of robots, industrial robots produced, costs are declining by more than 50%. So we think it's going to be a pretty explosive area, especially now that some robots are the cost of them is much lower than human labor.
Cathie, we'll have to have you come back and tell us what your impressions were of Figure AI once you'd actually seen the factory and seen the robot in operation. Let's touch a little bit on something you described, which is perhaps doubling down on some of those privately held companies that have seen down rounds. Let's talk about Reddit. So Reddit last raised money about 3 or 4 years ago at a roughly $10 billion valuation range. Chatter now that as a social media is doing its roadshow for an initial public offering, looking to raise about $750 million. That's the rumors that we're seeing reported in the press. The valuation, the enterprise value that's rumored, or the whispers at the moment, is in that $6 billion range. To your point, one of these down rounds. What's your plan? Does ARK plan to take a stake in that IPO?
We're studying it. We can never, for compliance reasons, we can never say what we're going to do. But be assured, we're doing the research. We find it a very interesting social network. We do our research. We give it away, and we see Reddit picking up our research, different channels there. So from an information network point of view, it's very interesting. But our analysts are still doing the valuation work and trying to compare it to what else is out there in the social world.
What's your instinct, Cathie, on Reddit standing to become a beneficiary from the AI trend? You know, we saw reported that there was a $60 million deal cut so that Reddit could help AI platforms use its content to develop its language sophistication. Do you think social media networks are the right places to feed content into training AI models?
Actually, if you look at X and Reddit, the kind of text-based inputs that they offer, how well organized they are, tightly constructed for the most part, that's very good data on which to train models. What's interesting about Reddit is it's selling this data or selling access to this data. Twitter in the day, when it was called that, had a data licensing model, and it's basically shut that down because it feels that its data is too valuable to give away and that it needs to develop this everything app using the data on it. So it is surprising to see that they have evolved a business and struck a deal like that, because if they were thinking about how proprietary their data is and how no one else has it, they probably should be thinking about using it internally to harness AI and make the product even more creative and useful.
Cathie, you just said something very interesting, which is X has made the judgment that the data it's collected is too valuable just to give away. The debate at the moment is the sort of second derivative of that. And this isn't specific to X. This is true of Facebook. It's true of Instagram. It's true of all these social media platforms. And the debate, which Europe is kind of leading more than the US, is it even theirs to monetize? Is this data even theirs to monetize, let alone give away? Because ultimately it's the user that, mindfully or not, has contributed their data for free into these platforms. Where do you think regulation might go as we look at the protection of consumer data, but also IP? Another piece has been IP, as AI is deployed to try and get smarter using existing bodies of data.
Yeah, it's a hot topic. I think we're in such early days here. This would be like in the early 90s saying, how should we regulate the internet? You know, we would not have the internet that we have today, for better or worse, but as enormous and all-encompassing as it is, had there been regulation. And I worry for Europe that it risks dealing itself out of, some major advances associated with artificial intelligence, because it's just starting to regulate too soon before we even know what we have. So that's one thing. In terms of IP, yes, that is a live topic. We brainstorm about it all the time. If you take all, songs that have been developed over time, you'll hear bars from other songs. They'll sound familiar. It's sort of, it would be sort of going after, songwriters today, and saying, wait a minute, you took those 3 bars of code from my song and, you have to pay me for it. So I think the precedent is going to be very important here. Hopefully it's not too stringent, because it would just be like regulation, just holding progress back, and really giving it to others. What's very interesting today is something called regulatory arbitrage. If one country regulates too much, stifles innovation, innovation moves to other countries that want it. We've seen this with drones. The US was FAA, very tough. Drone experiments moved to India, Australia, Hong Kong, UK. And I think we've seen it in crypto, with the SEC so against, especially, anything crypto. Saw a lot of that innovation move abroad. I think we're getting a lot of those lessons, and we should be very careful not to stifle AI.
Cathie, ARK Invest released its Big Ideas report. You and your team do this annually. And it's interesting because I know that part of your recruiting differentiation is you seek to find researchers and analysts specific to these domains rather than sort of traditional financial analysts to really try and go deep in there. When you look at the thematics in that report, which I encourage folks reading, it's a long, very detailed, interesting read. How much do you anticipate allocation of the funds you manage going to companies overseas versus in the US? Maybe because innovation has shifted, maybe it's the regulatory environment, but talk to us a bit about international versus domestic investing.
Yes. Because the cost of innovation is collapsing, the barriers to entry are also coming down. And so we are eager to find countries elsewhere, especially companies elsewhere that have, especially those that might have been, deterred in the US and have moved elsewhere. So, the US is not the only innovative country in the world. It has, because of Silicon Valley and the way our capital markets work, it has been really a beacon for innovation historically. We've been worried recently, as I just mentioned, and so we are looking abroad. And one of the ways we're doing it is we're going to harness AI itself and develop a heat map based on documents around the world where they're mentioning keywords that we think are important to innovation. Because I'm sure there are a lot of undiscovered gems out there. The issue also, once we find them, if they're in the private market, fine, that's great, we can participate. If they're in the public market, we need liquidity. And that is an issue sometimes in the rest of the world.
And in that heat mapping, Cathie, have you seen any early flashes of countries that are starting to hit your radar more frequently in terms of their innovation, where they have got publicly traded equity and the ability to provide the liquidity you need as well?
Yes. Well, interestingly, in the last week, China has shifted its mantra from common prosperity to new productive forces all around new technologies. And now when China puts its mind to something, and its command and control, usually they achieve a lot of goals that others think are not possible. So we're starting to look a little more carefully at China. I will say the regulatory crackdown generally, especially on the financial services sector, is still giving us pause. And so there are puts and takes. We think the new mantra, new productive forces, aligns with innovation and what we do, whereas common prosperity was more about cutting costs and getting new products and services into tier 3, tier 4, tier 5 cities. So looking more closely at China once more, and Asia, the DNA in Asia is all around innovation. That's what I mean by regulatory arbitrage. Countries in Asia are beckoning U.S. and in Latin America, as a matter of force. El Salvador, from both an AI point of view and a crypto point of view, is making life very easy for innovators who want to relocate there. And I'll be visiting El Salvador, I think, in the not too distant future.
Let's stay on Bitcoin as we finish up together here, Cathie. Bitcoin's accelerated past the $71,000 mark to an all-time high. You at ARK have the 21 shares Bitcoin ETF, which surpassed $2 billion in assets under management. With this rally, with the ability for more ETFs to come to market following the change in the SEC regulations around this, where do you think Bitcoin gets to? And where do you think your AUM as a result for that ETF could be a year from now?
Oh, a year from now. That's
forward-looking statements, just to tease out of the end.
No, well, we have a 5 to 7 year time horizon. And as you know, we're in print at more than $1 million per Bitcoin. So we think it has miles to go. We are delighted that we are number 3 behind BlackRock and Fidelity of all the new ETFs that are taking share from GBTC because of the differential fee structure. And we'd like to think it will stay that way. The interesting thing is we got to nearly $2.5 billion without any of the major platforms like Morgan Stanley, UBS, Bank of America, Merrill Lynch, approving Bitcoin on their platforms. And those are our big clients. So we are very much looking forward in the next 3 to 6 months to them putting the hopefully ARKB on their platforms so that we can continue our growth. So we think Bitcoin has miles to go, and we certainly hope to be on the journey in the next year or so. We intend to be, shall I say.
Bitcoin One will certainly keep watching here at Public. Cathie Wood, founder, chief investment officer, and CEO at ARK Invest. Thank you so much for joining. And again, please come back. Love to know how your tour of these humanoid robots starts to look. We'd love to get your perspectives.
Yes, and I'd also like to thank you and Public for our wonderful partnership. I think it's every Tuesday, Sam and Nick put out The Brainstorm, which summarizes our brainstorm from the previous Friday. And I even listened to it, even though I was at the brainstorm, because they pull nuggets out that sometimes I didn't even appreciate. So thank you, Public. We're really excited to be working with you.
Thank you, Cathie. Come back soon.